Okay, welcome guys to the Google Podcast. I'm your host, Rob Watson, and in today's episode, I've got the pleasure of sitting down and chatting with Bruce Davis. He is the founder and managing director of Abundance Investment, which has been at the forefront of financial innovation since 2012, creating ways for everyone to invest in green and social infrastructure. So I've been interested and keen to speak with Bruce for a few months now. So it's nice to be able to sit down to him, particularly in the current climate of everything that's going on around the world. So yeah, thank you, Bruce, for agreeing to have this chat with me.
That's no problem. Happy to do it. Yeah.
Perfect. So it seems like the thing that's on everyone's lips at the moment that is affecting everyone around the world is the coronavirus. So it'd be interesting to get your thoughts on that, and particularly the massive impact it's having on finance at the moment.
Yeah. I guess we're still working out what that is. So I think the immediate impact of the virus is it sort of demonstrates where the sensitivities are in our finance system. And if I'm honest, if it wasn't Corona, it might have been something else that kind of woke us up to what is really going on with our money and how it works. And I think, the thing that this has really illustrated is that a lot of what we sort of take for granted is very much running on a just-in-time basis when it comes to money, which you might sort of see as analogous to the way that people manage their money day to day in their own domestic lives, so outside of making investments or companies and all of that. And actually companies are no different. So I think what sort of perhaps surprised politicians is the speed with which companies have gone from being everything is fine and everything is, if you like, green light to, a complete stop. And we've never really been here before. I don't think we've ever seen a crisis like this where both demand and supply are constricted in the way that they are so suddenly. And businesses didn't have a plan for this. And they weren't really asked to have a plan. So I think what we're learning is that whilst, there's an immediate response to what is a cash crisis, fundamentally it's about cash. There's a bigger question here about the resilience of our infrastructure and the resilience of our society to these types of shocks, and whether or not we took it for granted that we could just respond from a standing start. And for us, I think I've sort of approached this perhaps slightly differently in that we've been looking at the risk, the very real risk of this type of shock, not necessarily a virus, an epidemic as we've got, but other types of shocks which would have an equivalent impact on the economy that relate to climate change and the climate emergency. So, you don't want to have any kind of situation where you kind of say, I told you so. But in this situation, what we've been saying about infrastructure and what we've been saying about the need for long-term investment, well, this is what we meant. What we meant was you invest in infrastructure for things which might happen, and you can't just go from nowhere to having something when it comes to infrastructure when things start to go wrong. And arguably that is the worst time to try and build and develop things. Much better is to be prepared for different things which might happen, i.e. we start to actually understand that investment acts as a form of insurance. And so, that piece for me has been quite interesting. So, aside from the human cost, which is terrible and tragic, and you can get very caught up in that, and people are acting very scared, and they're doing things which are ultimately probably not good for the whole, whether or not they're even beneficial to the one. But on the other side, it is, well, how do we learn from this? You should be alive and awake in these situations to learn from them, and when we get through it, as I think we will, come out the other side in a position that is stronger rather than weaker. So I think that for me is kind of where we're thinking anyway. From Abundance's point of view, we're an investment company that thinks over the 20-30 year time horizon with our investors. We're looking at, well, what does this mean for that approach? Is it more relevant, less relevant? How should we think about that? And fundamentally, you feel that actually this is the right way we should be thinking about our money. But I think the other part is, well, then also how do we support businesses that are in crisis right now? And I was thinking about money and talking about money back in 2008 when the crisis happened. This is far worse, as far as I'm concerned. It's not a crisis of finance; it's a crisis in the economy itself, and finance will be able, and therefore, actually, finance is in a position to do something about it. Whereas before, the financial crisis meant that we didn't really have a way to help ourselves. But actually, we do. We have a finance system that is still operating, able to operate with enormous support from central banks, but it is still operating. Whereas before, we had a finance system that wasn't functioning, and that was causing a very different set of problems.
Yeah, it's really interesting to get that insight from you. So do you see much impact on what you're doing? Or like you said, you're looking for the long term in terms of 20, 30-year projects, people's
Yeah.
investments. And obviously, you invest in green and social infrastructure, which is definitely the way the world is changing. And you're investing in the new technology rather than the old sort of paradigm, the system that is eventually dying out. But it appears that in a lot of ways, those companies are just holding on for dear life to take what they can and make so many more, whatever, trillions in that term. When yeah, so interested on your insight on that.
Well, I mean, in the immediate term, no, there's obviously a slowdown in activity. So we're looking at investments. We're looking at what investments we can actually bring forward to keep things moving, whilst a lot of things can't be done. There's no point trying to set up a construction site. That would not be the responsible thing to do. Where parts and technology come from overseas, again, that isn't going to happen in the next sort of 2 to 3 months, and possibly in the next 6 months. So we're looking at, well, what investments can we bring that don't require that sort of impact. They are things that can be done. They're positive things that can be done, but they don't make a bad situation worse just for the sake of doing something. And I think we've got a couple of things there. We're particularly looking at sustainable food production, which is an obvious, very immediate need in the UK, based in the UK. So how do we build the UK's resilience in terms of food production? And the other bit we're looking at is around broadband. So we're obviously, where I am actually is based out in the Cotswolds. I'm very much experiencing the joys of rural broadband. Normally when I'm here on my own, it's fine, but there's an awful lot of people have turned up in the Cotswolds region for obvious reasons, and the bandwidth has disappeared. So that's another area we're looking at, which is rural broadband and how that can be delivered. I think that the sort of the third one actually was we're looking at, well, the who are the kind of the actors that are going to get involved in rebuilding and also dealing with the problem that hasn't gone away despite what is going on at the moment, which is climate change. And that is really about working with local authorities, particularly local councils, and giving them mechanisms to raise money through their citizens that can be put directly into projects in their local community. And those types of bonds are quite different to what we've done before. So what we've been doing in the main is raising debt investments for companies. So as an investor, you're lending money to that company and they're paying you a return for the risk that you're taking. That's, if something goes wrong, what do I get for my money? When we're lending to local authorities, it's a very different sort of risk, much lower risk, much longer term type of investments that local authorities make. But importantly, they do make investments and they're looking to take the lead on things like the climate emergency, but they're almost certainly going to be on the front line of COVID-19. So what we're looking to do is say, how can we help local authorities do two things? One, raise finance for the projects that they need to do in a way that is cost effective versus, say, borrowing from central government. And secondly, do so in a way that engages citizens in the solution and shows that at a local level they can play a part. And so we're hoping to bring, still that those will still come to the market in the next 2-3 months from various councils who are, despite the challenges of where they are mindful of the fact that this is a temporary thing, and there are much bigger problems that they need to keep moving on, not just focus on the here and now.
Yeah, well, one thing's for sure at the moment, the environment is certainly benefiting from the slowdown.
Yeah.
I've been looking at the pictures that are coming out of China and Italy and even the UK. the heat map in terms of the release of
Mm.
CO2 and stuff. And it's and even in, you know, you've got pictures around in LA where the smog has cleared and the
Yeah.
air is clear. So obviously this isn't necessarily the route towards it we wanted it, but it can definitely act as a bit of a wake-up call.
Well, it definitely shows us what life is like when we reduce pollution. And I think, because I think people get normalized to it. They, you know, I used to live in London. I moved out because I got ill from pollution. I got pneumonia. Not the current one, but a couple of years ago I got pneumonia, and it was almost certainly caused by damage from pollution that weakened my immune system, because the doctors couldn't work out any other way that I would have got so ill. And I think, you know, what people are going to see is that actually the idea that life being different, if we respond to the climate emergency, doesn't mean that life is going to get worse. And the idea that the only way we can move forward is to move ever faster and bigger and use more resources, maybe that will be challenged too. So I sort of agree that there is some temporary benefit to the CO2 budget. Probably, almost certainly, energy usage is right down. But that doesn't really help us, because unless we're still building the stuff that we need to replace fossil fuels, it's merely it's a sticking plaster at best, and it may not even be that useful if governments just decide when they turn back on the taps that they kind of forget about green issues.
Yeah,
absolutely. So we need to keep that at the forefront of people. I don't think that will be the case. I think they will see this as an opportunity to renew infrastructure, to reset. But I think the biggest reset is for ourselves as a society to say, well, hang on a minute, what were the things we really valued before the virus? And in a post-viral world, do we still have the same values that we had before this happened? And I would hope that we don't. I would hope that this teaches us that a kind of, I'm all right, Jack, and this will be fine. Yes, some people won't make it attitude can trip you up in the end, because the one thing about Corona is it doesn't respect wealth, it doesn't respect status, it doesn't respect, well, it would appear not to respect royalty, and it levels everybody. And suddenly, I sort of felt this. You were walking, if you were walking past a homeless person 2 weeks ago and didn't do anything about it, thinking that person had somehow got there under their own steam, by their own fault, you can now kind of relate to the idea that you yourself were probably only 3 weeks away from being homeless. There are people who are. I have friends who don't know how they, if they didn't have these government actions coming in now, would be homeless at the end of this month. And so, and they were well-paid people who were living pretty positive, go-getting lives, and you take one little bit out of the Jenga pile and the whole thing collapses. So I think that for me should be a wake-up call for people, that our resilience, our sense of self-resilience, is often subject to some pretty strong confirmation biases, that we just can't imagine ourselves being in that situation. And maybe now we can actually do that because we're in it. And millions of people. You don't want to celebrate that. I certainly, all businesses are having to make decisions and struggle at the moment to get through this. But there's no point going through all this pain if we don't learn something from it.
Yeah, absolutely.
So I think it could be quite interesting in a post-viral world. Yeah, all bets are off as far as I'm concerned.
Yeah. I think as well, if it was, say it lasted just a week and then everything jumped back to normal, there'd be an effect on stuff like shares would drop, but they'll soon be back up, and people might be off work for a little bit. But because it appears to be a sustained period, it's going to give us a lot of reflection time. And I think we'll decide what is it that we actually need in our life. We have lots of wants, but actually what's important. And I think that us having that slowing down effect can help us to reflect on stuff. Now that might have a major effect on the economy eventually, but it might create a better economy for us.
Well, I think at the moment you've got this opportunity that the economy just went down by 25%. I mean, that's what they're saying. is the effect on our gross domestic product for this quarter, 25% reduction. That's bigger than the Great Depression in the 1930s.
Wow.
Now we're also seeing stimulus and government interventions on a scale that wasn't done in the 1930s. So they've learnt the lesson of the Depression. People didn't act. They thought it would sort itself out because there was an ideology at the time, perhaps not so different to certain elements of our own political spectrum right now, who think we should just let it run its course and come out the other side stronger. Actually, it doesn't work like that, because you lose people, you lose skills, people lose their homes, and they don't bounce back from that. They end up in whatever safety nets we have left. And I think this time the government's realized you can't do that. You have to intervene, and have intervened. Well, we'll see how big that intervention is, but they've intervened pretty massively. But I think for people, it's realizing that insurance policy, that element where the state steps in, that element where actually your public role, your public citizen role, is, becomes, you are a recipient of help from the state. I think that's going to jar a lot of people. I was running a focus group last week, actually, with some people talking about the investing in local authorities, and one of the things they said was how angry they used to get about their council tax bill. All the things in their council tax bill they never use. And I think now people are going to realize that actually some of those things were there, not because you didn't need them right then, but you will need them now. And so maybe people are starting to get a little bit more of a social conscience about this. Consciousness, maybe, if not a conscience. And that for me would be a good thing. I don't want to sound like I don't think that what is, as someone myself who's gone through pneumonia and ended up in hospital, you wouldn't wish it on your worst enemy. And it is a horrible thing. You don't want that to be the way that we learn our lessons, but it is what is happening. It's a reality that's out there, and I think we should learn from it.
Yeah, definitely learn from it. And then talking about just actually the financial system as a whole, you say we learned some lessons from 2008, but you still think there's some fundamental issues anyway with the way money's created and the redistribution of wealth and, inequality and, the way the system is almost feels like it's set up to support the corporations more so than actually the everyday people who are the ones that are, keep the economy going on a whole.
Yeah. What did we learn from the crisis? I think we learned from the financial crisis that we can't trust financial institutions to regulate themselves. And I think one of the reasons we're probably able to respond better to this quite different sort of crisis, a real economy crisis, is that our financial institutions are in better shape than they were 12 years ago. That's for sure. They have better capital buffers and reserves. Central banks are better connected to them and have more control over the way markets work. And to some extent, because we did such a huge bailout of the financial system, the concept of bailing out the real world is essentially harder to sort of rebuff if you were of that political persuasion. I mean, I think in America, they're having a very different debate to where we are here. And there's still people saying we should just, we shouldn't damage the economy, we shouldn't damage corporations and share prices and so on. Well, we're not really having that debate here to the same extent, except maybe around airlines. But I think the thing that it does sort of show for people is that they, however wealthy they are, and however financially independent they think they are, they're still part of a financial system that is both public and private. And that the public parts of the financial system are as important to your well-being as the private parts. And what we've sort of done over the period of time, and probably reversed somewhat since 2008, was a process where we were putting the creation of money through credit, the distribution of money, i.e. through earnings and shares and investments, into the private sector increasingly. And the public sector was playing less of a role in terms of creating money and less of a role in terms of distributing the proceeds of the economy. And I think we're now in a position where maybe that process will go into reverse. So it was sort of in limbo, I think it's fair to say, since 2008. We sort of stopped the rot of privatization of money, but we didn't do an awful lot to push it in the other direction. I think now we're in a position maybe where the public sectors or the public state, I don't know how you draw those distinctions, role in money and how it works is going to come to the fore again. Because essentially we've just nationalized our bond markets. We just nationalized, almost, not quite, nationalized our share markets. So, a lot of the assets that are out there are now owned by central banks. And they've done that for a really good reason. They want to put money into people's hands. They want to put money into people's pockets so they don't stop spending and the economy doesn't grind to a crashing halt. But in doing so, you're then saying, well, it's now the state effectively that runs the corporate debt market, which is, that's a bizarre situation to be in, but it is where we are. And then you sort of say, well, what are the controls and the systems that we have to make the people like in the Bank of England, who are now massive asset owners in the economy, responsible to us as a democracy? How do we hold them accountable except through, and at the moment that is literally only through Parliament. So yeah, there's going to be some interesting things that fall out of this. But I think you've seen that shift. I mean, we've probably seen, I don't know, $1 trillion or $2 trillion worth of assets go onto central banks' balance sheets in the space of a week. That's enormous amounts. I mean, in the grand scheme of things, maybe it's not that big, but that's bigger than the bailouts of the financial system. We've seen bigger action than we did in the first days of the financial system crash. And nobody's batted an eyelid. For this phrase, we will do what it takes, has become normalized. When that was said the first time, it was shocking. When Draghi said it at the ECB, with the Euro debt crisis, we will do what it takes, and it stopped the market rot. Well, he sort of set the precedent now. So now when things go wrong, we are looking to the state to solve it through whatever mechanisms they have.
Yeah, interesting times. And I think because everyone is being affected, so even go back to the 2008 crisis, maybe a lot of people, it was only affecting them if they actually turned on the news. Their day-to-day they could still go out and get what they wanted. Most people's jobs weren't affected, but now every single one of us is going to feeling the effect of this, not just financially, but our movements, everything, social, the way we can interact with people. So I'd love to think that when we do come out of this, and we will come out of it, whether it's in a few months' time or longer, that because we've seen how much it's affected us, then we will, hold, as you say, corporations and the government more accountable for things, rather than just thinking, it doesn't matter. And because everyone isn't going to be getting distracted by all things in life, like football or any other things which can tend to keep you busy at the weekend, there's going to be a lot of spotlight now on the governments. And I don't think they really have to step up. And I think they are to some extent, but I'm interested to see, because I know we're speaking about this on I think it's the 25th of March. And I think there's going to be some extra support coming out for, say, the self-employed and stuff like that. Because I know there's a lot of discussion, it's been in the background for a while, about universal basic income. And that's kind of almost really comes to the forefront, even though it doesn't seem like it's going to happen. But it's really come out. What's your thoughts on that?
Well, I mean, in effect, we're kind of doing it, and it looks like the universal basic income is $2,500 a month. Now, it's not that, is it? It's not a guaranteed payment to everybody, but I think it is. Well, we'll see. I saw some interesting rhetoric shifts today and yesterday. So yesterday, the news broke around the self-employed help, which, for a lot of people is pressing issue. They feel like they've been left out. It's 5 million workers in the UK. And, no one seemed to be really thinking about what they needed to do. And so there was a sort of push out that, there is an amendment being pushed through, I think, by the Liberal Democrats. Sir Ed Davey, though, is leading it. to the coronavirus bill, which would provide, self-employed and freelancers with similar protections to what is being given to the employed. What I've since heard is a lot of talk around how complicated it is to be able to deliver that and how expensive it might be. And I think, well, that, to some extent, I think politicians have learned a little bit, that they have to respond in a different way to this crisis. But that is old language. That's the language of, well, we can't risk the public finances. We can't, fundamentally at the moment, if we don't do this, we won't have public finances to come back to. So the idea that is literally like, someone who won't lend a mate some money and then finds out that actually they needed them for something else in the future. It is very short term view, and I think we will see whether those lessons have been learnt, whether people can leave their ideologies at the door, at the doorway, and step into something different in terms of the way we need to be thinking. And we've seen it in terms of the coronavirus measures. This idea that somehow we were constraining liberty by allowing people to get infected with a virus, which, when you actually say it out loud, is a stupid thing to think. But perhaps they hadn't said it out loud until they did, and then they realized just how bad that sounded. And I'm hearing the same kind of ideology around this bailout. So let's see. But I think the core of it, though, I think ultimately they won't. This requires a complete rewrite of what you might consider to be the social contract. And the social contract is that, as the state's role in supporting you and enabling your life, and vice versa, and what you give back to it. And a fundamental shift, therefore, in what we consider to be sensible use of public money, from probably a context, if this had been a limited effect, let's say that it was a virus that only targeted a segment of the population rather than the whole population, maybe people wouldn't be feeling so generous. So yes, I think that's going to be a kind of interesting psychological shift that will develop into a political one. But I don't know yet that our political masters have quite woken up to what that means, and what it means for them as politicians. The things on which they base their knowledge and power have been completely blown apart. So yeah, but I think, if you spent your life trying to get to that point, and then you get there and you find out it's not what you thought it was, it takes a little while to adjust your set.
Yeah, for sure. We're in uncharted water at the moment, so we'll see how this all pans out. But it's definitely going to have ripple effects that's going to go on for generations, and potentially can be positive ripple effects. Because and whether this is, who knows? Like you work, all your work, and we'll get onto this a lot more. In the green technologies and stuff, and how crucial they are, because we don't want to at some point this be a kind of like a test run for something even more major in the future, complete ecological collapse of some sort. Because at the moment, what this is affecting, it's affecting human beings. It's not kind of affecting us being able to grow food. It's not being able to affect, generally stuff like that. It's affecting us. But if something else comes in that really has a knock-on effect, then hopefully the lessons we can learn from this, we can put them into place for the future.
Well, and I think the thing that, because people often, I think, frame climate change in terms of the impact on the environment, but in reality it's an impact on humans. And so the idea that we can ignore it because nature will absorb it, or we will mitigate ourselves to the changes, is to kind of overestimate our resilience, and perhaps to think that on my own as an individual, and maybe I'm a successful individual. I don't know who that person is who thinks that they can survive climate change, but I think fundamentally, if society breaks down because of it, a lot of the things you take for granted that enable the world you've created will disappear. And so, for us on that green side, it's been relatively hard to make the case for green investment up until the point, and the sort of tipping point was when countries like the UK signed into law the need to go to net zero by 2050. When we signed that into law, and we had Extinction Rebellion and so on, really telling us this is an emergency, and putting themselves in harm's way to make the point, that we started to realize that actually when you kind of went, oh, well, what does that mean for me? Actually, it's pretty negative for you if you don't do anything about it. So we've gone from where green investment was seen as a sort of nice to have ethical choice to being a fundamental choice. And actually the ethical choice is not to do it now, i.e. the ethical choice is to ignore it. And that's a negative ethics. It's the ethics of selfishness or short-termism or not willing to take responsibility for your actions. So we've gone from a world where taking action was somehow you going against the grain to taking no action being going against the grain. And I think that's still filtering through in terms of what we're seeing for green investment. But I think it's generally very positive. But I think we've got to make sure that where we are now doesn't take the momentum out of that we don't go back to the world and go, well, we got through that. We've learned some lessons from it, and then we forget all of it when it comes to climate change. Because I think if we do that, then no, we haven't learned from this crisis. And you're right, bigger and nastier things are going to happen in the future that will teach us that lesson, and we will be less well prepared for it. You only have to look. I mean, today I think it's a sunny day. 25% of our power is coming from solar today. Another 20% is coming from wind. And despite the warnings that would mean we couldn't turn our lights on or something, everything's fine.
Yeah.
So the grid can take it. Strange. So I think we're kind of, and I think that's the other thing people are beginning to realize, we are actually already starting to live in that green future, and it's actually not that bad. Yeah. We're not being made jobless. People aren't. We were actually making progress. So yeah, I hope that we keep that momentum going.
I think because we've come so far, like you say, 45% today is from wind and solar. That is very impressive. And to think, in another decade or so, that could be up to, well, I don't know, 70, 80.
Yeah, and it needs to be 100% by 2050. And, at the moment, it would seem perfectly possible to get from where we are now to 100%. Whereas when we were down at 5% or 4 or less, yeah, I don't think it was an easy sell. Selling the idea of investing in a wind turbine, you felt like you were trying to hold back a herd of elephants with a kazoo. And now, no, the tide has turned. We could still do more. We should be investing much more in tidal. We should be investing much more in onshore wind than we are. And hopefully that will change now the moratorium has come off. We should be seeing still a lot more solar. We can build a lot more solar. And so all of that can happen, and the things that you need around it to keep the grid stable. And it's all possible. It's all affordable. So yeah, that's now really the task, is to keep people realizing that this isn't an expensive experiment in mitigating climate change. It is the only option, and we've got a limited period of time to get it done.
Yeah, for sure. What are your thoughts on geothermal as well? Because I understand, is it the Eden project in Cornwall that are doing something at the moment where they've got something in place, so they're going to get all their energy literally from the Earth's core. And I know up in Ireland, they've got a big push on that as well.
Yeah. Well, the Cornish one is actually from the fact that their rocks are a little bit radioactive.
Wow.
But, so yes, granite has a heat to it. And you can take that heat and use it. And we invested initially in a geothermal project in St Austell, not far from the Eden project. It's a question of, for that one, it's a question of scale. So for Cornwall, I think it's a very good solution. They have a lot of hot rocks there. And I think what they're finding, we invested in sort of the early stage of that project. It's a lot, drilling down through 4 kilometers of granite is no mean feat. And yes, it produces energy and that can be used locally. And, Cornwall itself is already a very green generating county. It has lots of wind, lots of solar down there. So for me, it's one of the elements that should be considered, certainly wherever it can be done. Probably the bigger use of that particular type of technology is really the level to which we should be moving as many homes as we can to ground source heat pumps, which are a more sort of manageable scale of technology for thinking about this, rather than 4 kilometers down. You're only drilling down every 10 meters. And air source and ground source heat pumps are the things we will need to replace our gas boilers. And we do need to demystify that for people. We do need to help people understand that, putting in a new gas boiler maybe in 10 years' time won't be a good decision, because you're a bit like buying a diesel car around that time. You won't be able to do it after a certain point. And certainly the housing developments that we've been funding that are green have got a combination of solar and ground source power, and that reduces the net energy demand on those homes by 93% in terms of pulling off the grid, and significantly reduces the carbon footprint of that home over its life. So that's doable now. That's social housing. That's not expensive houses. It's not some sort of grand designs passive house. It's just a normal house that someone's going to live in for 50 years as social rent. And it's affordable now to implement those solutions. So I think we need to do more of that, and perhaps a little bit less. I think I mentioned tidal, but we shouldn't get distracted by the really big scale projects and forget that a lot of that is about putting turbines under the water in places where there's a really strong tide. And those aren't big, they're not spectacular. They don't transform the environment, and that's probably a good thing, but they get the job done. So I think, we do need to, sometimes you find in the green sector that engineers get very excited about certain solutions because they're engineering solutions, and they don't get so excited about installing 15 million heat pumps. They should, but that isn't the same thing as a massive tidal lagoon, is it? So I think, for us, it's about identifying the technologies that are doable now, affordable now, and scalable now, and not putting too many bets on projects that could have a huge impact. Carbon capture, these are not tried and tested technologies, and they're not proven that they will scale. We've got scalable, proven stuff. Onshore wind. If we were allowed to increase the tip heights on onshore wind, you could increase the capacity of onshore wind overnight, because everybody who's got an onshore wind turbine would put bigger blades on. And there's a rule in physics, the cube square rule. If you increase the area of a wind turbine, you get a cube of energy out. For every square foot, you get a cube worth of energy. It's exponential. So we can do that now. So yeah, I like things like geothermal. They get people excited. We've looked at a number of different things, like we've looked at floating tidal turbines. These are all great projects, and the important thing is that they should scale.
Well, like the heat pumps in homes, like you say, putting that into 15 million homes is, when we actually, where we live, we looked at solar, but our position of our house just wasn't feasible. So it was just not going to be a good investment. But I think the heat pump seems like a really wise move we can all be making. And I love that you're talking about the fact that the houses that you're investing in, council houses, and making them 93% more efficient over the lifetime. Like you say, this is available to all of us. And and I think, is it over in California now that all new houses after a certain, I don't know when it's been passed, but have to have solar in place on them?
Yeah, and I think it's, and yeah, we're improving the building standards here too. But I think that, to some extent they always get watered down. I think it's really down to developers. So we back developers who've got that enlightened view. And what we hope is there's a degree of both peer pressure and hopefully financial pressure over time, when people realize that the sort of short-term model where you're going to build a house, which is the equivalent, as to say, of buying a diesel car just before 2040, is that if you buy a house like that and it isn't up to code, it isn't up to where codes are almost certainly going to be, and it isn't powered in ways that are almost certainly going to be banned at some point, then you haven't really, you're not buying the best home that you could. So sometimes I think people need to look beyond the granite worktops and whatever else might attract them to that particular property. And the first thing you should check is, how is it powered? Is it sustainable? And will it be illegal to run my house in 10 years' time? So I think, we don't really get that. And I still get frustrated if you look in the property pages and they still treat going green as if it was like buying a granite worktop.
Yeah.
And, it isn't that. It's not going to pay back in the ways that you kind of expect. In the same way, actually, your granite worktop never pays you back. But we can get our head around a shiny worktop. We can't get our heads around a heat pump yet.
Yeah.
But where I live, we're not on the gas grid, and I don't think at this stage it's I think the prices could come down a bit further, but actually most people around here, they probably won't be able to burn whatever it is they're burning in their homes probably before the gas grid gets turned off, and but no one's thinking about that, and they're still building houses with kerosene boilers, which is madness.
What does it cost to get a heat pump fitted into someone's house?
It depends how you install it and how much land you've got. So if you've got a reasonable sized garden and so on, you don't have to go so deep. So it's all about whether or not, and often I think the ones we've been installing have been shared across properties. So you drill down a deep bore as part of the new build. So I don't know how easy that is to install in an existing home. And I've seen some quite big numbers. Obviously, where I live, there's a lot of marketing of these types of investment. At the moment, the numbers feel quite big, like £25,000. I don't think that's ultimately where the price will net out, and the technologies will get better as they get invested in. So at the moment, yes, it would be hard for someone to sort of justify that unless it was a shared heat resource for, say, a group of flats.
Yeah.
But that doesn't mean we shouldn't look at it. And it does, a lot of the incentives that were put into that area haven't yet had the effect of encouraging industry to reduce costs. And they need to do that. We need to have an idea that heat pumps are going to come down in price, are going to become more efficient over time, and incentivize industries to do that, as we did with offshore wind. It can be done. It can be done. But at the moment, there isn't a great deal of sort of joined up thinking, is my impression, in that world. It's still very much the fragmented world of home heating is a real barrier to any kind of change coming through there.
And then talking about your projects that you've got funded, is it you got 42 projects currently funded?
Yeah, so just over 100 million, 42 projects. As I said, at the moment, the current one we've got is you actually can only view it if you're a sophisticated investor for various short-term reasons. The FCA kind of took a view that property investing needed greater controls on it for a while, which is a frustration. We don't believe that what we were doing should have been caught by those rules, but it is. And so we're looking at the green social housing, but as I said, the main things we're now looking at are we're looking at energy projects, particularly around anaerobic digestion and so on. But we're also looking at both broadband and sustainable farming projects, because really we can't dictate to the market. We can provide investments where the market is making its own moves. And those are some of the sort of really sort of hot areas, if you like, in terms of new things coming through. And then I would hope to see a rise now in the number of wind projects that are looking for investment on the back of the ending of the effective sort of, on the back of them being awarded contracts for difference. So this is the markets, the mechanism whereby if you're building long-term projects like wind turbines, which they generate for 20, 25 years, you've got a guarantee in terms of the lowest price that you will be able to get for the energy. And that does two things. Firstly, it kind of encourages people to bid down to that price. And secondly, it reduces the cost of the investment in terms of its interest costs, because it's lower risk, which in wind reduces your cost of energy. So you've got kind of like this beneficial loop, positive loop, whereby you reduce the cost of energy by reducing the cost of investing in that project. And at the same time, because it's a competitive market, those contracts for difference, you encourage them to bring in innovations that increase the efficiency and effectiveness of the wind turbines themselves. And there's loads of things that can be done with a wind turbine that make them more efficient and increase what their capacity factor. So how much of their energy capability is realized, whether that's because of wind changing but being more efficient in being able to use different types of wind conditions, for example. That's all, wind turbines look quite simple on the outside. On the inside, they're quite complex machines, and they need quite careful management to get the most out of them. It's a bit, I'd liken it, it's a bit like sailing a boat. You can get the trim and the sails and the mast and everything just right for the wind conditions that you're in, and then suddenly the wind either dies or gets stronger, and suddenly you're having to change all your sails and to get the same efficiencies. It's the same with a wind turbine.
Interesting. Yeah, like you
so
say, they look quite aerodynamic and quite simple from the outside, but there's a lot of technology underneath.
Yeah, it's to do with the way they feather the blades and all of this and point them in the right direction and know where the wind's coming from, of course. That in itself is quite a bit of kit just to have it pointing in the right direction. You'd think it would be easy, but it isn't.
One thing, I first found out about you guys from Positive News magazine. I had Lucy Purdy on, I think it was episode 2 of my podcast, and I get the subscription every few months comes through the door, and I noticed you guys are known. My first of all, thought, right, I want someone from here on my podcast, but also I was interested in it from my side of things because I've banked with the Ecology Building Society for years, and they seem to be one of the highest rated green sort of banks that you can go with in terms of only lending money for people who are building sustainable green homes. And then seeing your side of things, where actually, not only are you doing good with the projects, but it also means, like myself and other people, they can make an investment through you guys and see a good return and knowing exactly where their money's going, rather than, they're just putting it into, wherever. And, you might accidentally be supporting fracking in some way if you've got your money in shares in some way. So that's great. So, and how does it go about? Say I wanted to make an investment with you. How simple is that to do that, and how low can that investment be?
Well, the minimum investment is £5, so that's a relatively small amount of money. So you do two things really when you come to our site. I think the first thing is you might see that we've got projects available. So it isn't always the case because we're not a fund. So what you're doing as an investor is you're choosing to invest in a specific project that needs financing, and that will be over a finite period of time, maybe 3 months. So you come to our site and we'll have something available. It could be a wind technology project. It could be a new tidal project, whatever that is, and that will pay you a particular return. And then basically you need to sign up with us to join the platform. And that does, two things. Firstly, we make sure that you are able to understand the risks of investment, that this is an appropriate investment for you to be making. And you have therefore you have to pass a little questionnaire test. And the second bit we do is we open a bank account in your name. That will be where you can deposit cash to buy the debentures. And the debentures are, it's another word for bonds, but these are issued by the companies or the projects, and they are they are a form of debt. So you're lending money, and they pay an interest return, which is different for each project. They pay that return over a period of time called at maturity, which is different again for each project. Could be 2 years, 5 years, 10 years, up to 20 years. And then you deposit the cash. That can be either in a general account or into an ISA account. If it's an ISA, it's called the Innovative Finance ISA, which has been specially set up so that crowdfunding investors can get the benefit of tax relief on their investments. So all your returns are tax-free. Any capital gain is tax-free. And then the last bit is, so you've got your cash, you've got your ISA opened, then you see the investment you want to buy, and you buy anything up from £5 up. And that investment might be offering £5 million worth of debentures. You'll take a little share of that. And once you've bought the certificate and the project is going ahead because it's reached its minimum target, you then get that investment, and then every 6 months you're going to get a return from that company in cash that you can then either choose to withdraw or reinvest through your account. And so people build up a portfolio. So usually in the first year, people make 1 or 2 investments, and then they slowly make more over time. So our average investors maybe made 10 or 12 investments over their life with us. And so they're earning money, usually 3 or 4 times a year. They're getting a payment from different companies, which we provide them with, along with an update about how the project is going. And those are all held in the website, so you can kind of see what you've got. And for some people, that might even be their pension, because we've also got a self-invested pension product. And actually, Ecology themselves are investors through our site. They joined our site as a customer. They've bought into some of our projects. So some of the return on your savings is coming from Abundance projects already. But I think the broader kind of group, we're really built around the retail investor, so that's where we focus. So the idea then, as a retail investor, you should be able to see these different projects, and then if there isn't anything there to invest and you've got some cash that you want to deploy, you can buy from projects that have already been funded through the marketplace. So there's like a secondary market, like a stock exchange, and that will be buying direct from other customers, like eBay. So you set a price, you agree at the price, and then you tell Abundance that you've agreed it, and we transfer the funds and the investments over. So of that 100 million, we've had about 25 million of returns, both in terms of capital and interest to those investors. And then about 4.5 million of those debentures have been traded through the marketplace. So it's quite a busy site in a way, although we might have projects, they tend to come in threes for some reason, but we might have projects not all the way through the year. There's always something that is happening on the site during the year.
What I like about it sounds really transparent, and you can see exactly what's going on, and it doesn't sound, and it sounds, for someone who might not be into this side of things, quite clear and quite simple in some ways.
Yep.
Not necessarily the marketplace, but the idea of just setting up an account and go, I choose that investment, and I'm going to put in £500. Then what kind of what tends of rates do you tend to have on them?
Well, as I say, it's a bit of a range. So the lowest rate at the moment you will see on the site is around about 4%, and that goes all the way up to 15%. Now, obviously, a 15% project is quite high risk, or very high risk. You don't get 15% return on a debt, on a bond, without taking some risk. But the bulk of investments, I would say, are in the sort of 6 to 10% kind of range. When we're looking at local authorities, it's a very different type of risk. We're probably looking at returns between 1.5% and 2%. So quite different. They're still investments. They're not cash. You're not depositing with them. You're buying a bond, a long-term bond, but it's going to pay a lower return, because a local authority is a much lower risk of default than a company. And we hope that people will kind of diversify, that they'll look at the local authority stuff for stuff that we want to keep secure, and relatively stable, and the other stuff is varying degrees of risk and return depending on what you're trying to use your money for in the long run. So yeah, that's the sort of range we're dealing with at the moment. And I just want to go back on that marketplace point. You're absolutely right. That isn't our simplest part. And then, yeah, there's a project we're doing at the moment to come up with a better way of that working, so that it's more accessible to people, particularly when they first join the site, because I think it could be a bit overwhelming to see all those projects and deal with it. But hopefully over time we'll make that easier.
Yeah, I'm sure. Well, even, you talk about even local authority 1 to 2% compared to what people are getting with the savings at the moment, and the bank rates just dropped to practically zero. So people's savings are going to be affected even more. So to make that investment in, as you say, a local authority, which is pretty solid and secure, but then probably the wise thing would be to split it, wouldn't it, between 4 or 5 or 6 different investments, maybe one high risk, one at 6%, 10%, 2%.
Yeah, exactly. It depends what pot of money you're using, right? You might have a pot that you're willing to take some risk on. You might have a different pot. Maybe it's saving for kids' education. I don't know, saving for your kids' future. You don't want to take any risk on it at all, but you do want to make a bit of a return. And I think that's, so there is an element where we're looking at people's financial needs, and the other side is we're also looking at outcomes. And so, because the other thing you want is to know that your money's making a difference. So we're also looking at how we can make that a little bit more real for people, because at the moment we'll talk about the story of the project, we'll talk about what the investment's physically doing, but we don't have a very easy way of talking about impact, because a lot of impact measurement is done on a very aggregated way, because it's designed for funds and investments into companies like shares, holding shares in an index. We're investing into real projects. It's pretty obvious a wind turbine has a positive impact on the environment. How much, and how much is it better to do solar versus wind if you want impact? I don't know how you calculate that. So yeah, we're working at how we might make that a little bit more real for people, so that they're not only sort of seeing their investment return and the projects getting completed and so on, they're also seeing the impact. And that's kind of the next step from where we are now.
On the pension side of things, can people transfer from current pension providers into this?
Yeah.
Yeah,
They can, although we would never advise. If you have to be very confident that is the right thing for you. So pensions are complicated investments, actually, in terms of the way that they work. So someone that has a pension that pays a defined benefit, i.e. final salary, we would never be recommending that they switch to a SIP. They could still make that choice, but we would never ever say that's a good thing to do. Where people have defined contribution, i.e. the amount you put in affects how much you get out, then I think considering if you've got a pension pot and you want to consider a percentage of that to go into very specific projects that are a different type of risk, then our SIP is kind of designed for that. Now, some people have gone all in. I mean, I'm personally, my whole pension is in my own SIP now. And I used to have a series of pension pots that I built up from different jobs, and I put them all in one and then put them all into the SIP. But I would never say to someone that's not necessarily the best thing for people to be doing. I think they should be looking at their pension pot and saying, can I invest in an ethical general pension fund? And can I put a percentage of my money into an abundance pot, which will get the same tax reliefs and it will get the same benefits, but is doing a very different type of investing? And I think that's why people need to weigh up. So for some, yeah, they've gone all in, but for the most part, people put up, a lump sum, which is a share of the sort of pension monies that they've got in different places.
And you could always, like from my perspective, you're saying I've got a couple of pots from different jobs over the years. So you might take one of the smaller pots and invest to see how it is in 5 years' time, and go, actually, I'm going to bring some more over as well.
Yeah, and there's a process for doing that. You just transfer in, and when you subscribe cash into a pension, you obviously get, depending on what tax relief you get, you either get the 20% boost or the 40% boost immediately anyway on your savings. So there's lots of good reasons for using the pension system to save for the long term, and our investments are long-term investments. But I think, the risk of those investments, for our new investors, we're telling you not to invest more than 10% of your net investable assets in what you're doing. And if you want to do more than that, you need to sort of say to us that you understand what you're doing and you're a sophisticated investor. So the bulk of my investors are in that sort of lower level camp for whatever reason, their own personal reasons. So they're not investing more than a certain percentage of their money. Others, no, they've put in large amounts, and it's large amounts of their capital that they have are invested in green through us. But like you say, you've also then got your savings in ecology or your savings in Triodos or wherever else. We're not telling you that you should be putting all your money into one type of investment. What we're saying is we're a really interesting investment to sit in your portfolio, and then you should consider how much you want to invest.
And how many investors have you currently got that are,
6,700 in total at the moment that have done that 100 million. There's slightly more accounts than that because some investors have designated accounts for grandchildren and children. But the 6,700, adult investors.
Yeah, that's interesting. I like the idea of putting something away for, a child, putting something in for, 10, 15 years and seeing when they get it when they're in the teenage years or when they're older. And yeah, that feels good. And also it's good from that child's perspective to know that the money that they're going to get back has actually been supporting something, like you say, whether it's
it benefits their future, right? It's their future is going to be the green future. And they're invested in it is probably not a bad thing. Yeah,
absolutely. And it's win-win because you're investing in a better future, but you're actually getting a profit out of it as well. So
yeah, that's the idea. And I think, we talk about win-win investing sometimes, and whilst it feels like a little bit of like a marketing cliche, generally people agree with it in our context because they can see the two benefits sat next to each other and they don't compete. The idea is that the financial return is not at the expense of the impact and vice versa. You shouldn't be doing impact and getting a worse return than the market provides. For the risk you're taking, this is the return. That impact that you're creating doesn't really affect that. You get that as well. And those are difficult investments to find. Not all investments have that win-win, but we try and specialize in that.
Yeah, absolutely. It's great. And I'm interested from a personal perspective, how did what brought you to set up Abundance Investment in 2012?
It was two things. I worked as an anthropologist studying money, and in the process of doing that, helped create the sort of sister market to crowdfunding, which is peer-to-peer lending. So I was one of the team that founded Zopa, and did a lot of research with people in their own homes, looking at how they use money in everyday life, and that formed the basis for a lot of the work we did on Zopa. And then secondly, kind of wanting to do something in terms of sustainability and finance, wanting to do something new in terms of financial model. And I met up with my co-founder, Carl Harder, who introduced through a mutual friend who said, "You're thinking about doing green investing. Bruce is thinking about peer-to-peer lending and what to do next." And within about 30 minutes of meeting over coffee, we'd sort of set the kind of template for what we thought abundance might be. And then it took about a year to develop the concept further, and then 2 years working with the Financial Services Authority, as it was then, to get authorized to be able to operate as a business. It's quite a long process, because we were the first truly new financial innovation they'd seen ever. Since the FSA was founded in 1997. So we were coming through their doors in 2009. And in that period, they'd never had someone new come to them saying, "We want to do a new form of retail investing." So they couldn't get their head around it. So they're like, "Well, why? Why do you want to be regulated?" And it's like, "Well, because we do. We think it's the right thing to do." They're like, "No one ever says that." Mostly people come to find out how they can't be regulated. So we were kind of breaking the mold. So yeah, so that brought us then in 2012. That's when we launched our first project.
Exciting.
Mm.
So what
Feels like
about,
a long time ago, but yeah.
it's really interesting to hear about your kind of key role in peer-to-peer finance as well, because that's really
Right.
shaking stuff up, taking out the middleman.
Yeah, that's the idea. Well, it was a team from Egg Bank who sort of was a more consumer friendly, I guess, bank at the time. But we all got rather frustrated with Egg. It rather weirdly became more about a credit card than anything else. And so we used to meet in a barn. The founder of Egg had a barn in Buckinghamshire, and we used to meet there every Monday. And everybody was sort of, this is when the idea of the gig economy and working freelance was all rather new and exciting, rather than mainstream. And so we were all in the gig economy. We were all kind of doing different things, and we decided it was good to be able to meet together and come up with ideas together and maybe work on different things together. And the basic agreement was, if you did, you put a percentage of your money into a pot that would fund collective ventures. So it was called the New Barn Collective. And that collective, at one point in time, quite hard to nail down exactly when, we had a conversation, and out of that conversation came the concept of peer-to-peer lending. And depending on who you are and where you are in that process, depends on how you remember the story. But as I remember it, there were three of us sat down, myself, Dave Nicholson, and James Alexander, and they were thinking about a new way of doing sort of a kind of bond market for individuals. And I was talking about the need to make money more social and more networked. And somewhere in that conversation fell out the idea of it being a peer-to-peer network. And what would that look like? And then we drafted it up. We kind of ran it past some people. Some people thought it was a rubbish idea. Other people thought it was great. And then then they went and got a load of money to invest in it. And because in 2003, 2004, there was a lot of money looking for new fintech things. And really from then, it was quite a slow burn for the first 3 or 4 years, because people just couldn't really understand how this worked. And then slowly people got used to it. So by about 2008, when the crisis hit, Zopa was growing pretty quickly. And then post the crisis, it really came into its own, and then it became regulated itself in 2014. So we've kind of come a long way from 2003-4 to where we are now. It's just over 15 years. And they've done, I don't know, 3 billion, I think, cumulative lending. It certainly, as I say, two things. One, it hasn't grown as quickly as I thought it would. I thought it would catch on more quickly than it did. But almost where it is now is a more diverse and interesting sector than I ever imagined. So the Zopa model may not be the biggest or the most dominant, but that's funding circle really. But where we've ended up with crowdfunding and peer-to-peer lending is a much more interesting environment than I think we ever really thought when we were coming up with the original concept.
Sounds exciting. Quite a journey that you've gone on there the past, yeah.
A long time. Yeah, I was 33 when that started. So yeah, it was, and the world was a different place. We were all on MySpace.
Yeah, that was a long time.
I remember we called it eBay for money, because eBay was the kind of new kid in town and was very exciting and growing, and we said it's eBay for money, and I could have said MySpace for money, and that probably would never have got funded.
When did PayPal came about? Was that around the same time?
Well, PayPal fell out of eBay, didn't it? So yeah, about the same time.
Yeah.
That was the sort of Silicon bubble was just growing then, and I think Zopa for a little while got distracted by that. They went over to California. They wanted to work with the big tech companies. That didn't work out because regulation in the US is very complicated and not very supportive of new ideas. And so in the end, they came back to the UK and we grew it from there. And now there's a global market for peer-to-peer, which is in the hundreds of billions, all across the world. And Zopa is the start of all that. But it's unclear where it will end up, I think, because it's now evolved into these different species of finance, because in each, although finance is global, regulation is very local, and particularly for retail investment. And so you get these different ecosystems. And so what works in the UK doesn't necessarily work in France or Germany or Italy or the US. So you don't see these big rollouts as you would with, say, Facebook, for example. The way we do social media is much more homogenous. The way we do money is hugely fragmented.
And you see that changing?
No. Because money is social. We don't, I think the crisis, the 2008 crisis, came out of an attempt to globalize money and make it the same everywhere. And when you do that, you create these unintended consequences that one person's attitude to debt is not the same as another's. One person's attitude to paying off their mortgage is not the same as somewhere else. But if you carry those assumptions across, it can really catch you out. And we learned that the hard way with Egg. We tried to launch a credit card in France and it failed. And it failed because we made it work like a credit card in the UK. And we thought, well, what they need is the UK model imported into France. And French people were like, what is this? This is not a credit card. This is something else. And yeah, it didn't work at all. And so you aren't dealing with, although the words are the same, you're not dealing with the same meanings. So what it means to be in debt in France or Germany or Holland is different to what it means to be in debt in the US or Asia or Russia. If you want an interesting culture of money, you go to Russia. They have three types of money. They have white money, which is the money you earn from your main job. Black money, which is how you buy a house from the mafia. And grey money, which is your second job, because your first job doesn't pay very much. So and they're fully, that's how money works. They have three different types of money. You pay tax on white money. You pay a different type of tax on black money, because that's not the world you want to get involved with in Russia. And grey money is a reality. Grey money is what we would call cash economy, but in Russia it's not. It's just normal economy.
Wow, that is fascinating. And I think
so yeah, carry on.
No, and that's really interesting when you say about, the idea of trying to launch a credit card in France, it didn't work. And I think that can be often the approach when you look on a government level, when everything becomes so centralized, then trying to make decisions for someone who lives the other part of the country. It's like, actually, I think we can potentially ideally move towards decentralization of power, give more power back to local authorities, local areas. And then from that, because they're the best people to make the decisions, what's in their interest, rather than being told what they should have.
I think so. It's definitely about I think some of the democratic deficit that we're suffering from comes from that centralization, that people don't feel represented by a parliament that is hundreds of miles away and seems to talk a different language. Despite sending an MP to it, that doesn't seem to cut it for most people. So yeah, I agree. I think it's also, that the attitudes we have and our responses to these problems are different in different places. So again, a one-size-fits-all solution doesn't really work, because it imposes values on people that they don't necessarily share. And I think if you're in Westminster, you kind of assume everyone thinks a bit like you until they don't. And I think the corona crisis has shown that. You might think you're making perfect sense saying social distancing, but how other people interpret that is completely unpredictable. You might tell people it's okay to go out and get fresh air. What you didn't realize is everyone would have the same idea and all go to the park. So that's sort of simplistic, but I think there's a more complex set of unintended consequences around the way we're making decisions about our future and our politics, which are the same, and our money. They assume if I give you a £5 note, that you'll have the same value on that £5 note as I will. That will be true. We both value it at £5. The values that we put on it are completely different. And I think that that's the bit that causes things to come unstuck. And most economics deals with money as if the value is always understood as the same. It's neutral. But economics has never had a very strong relationship with values. And so, yeah, we find I think at the moment our economics isn't working because it isn't able to deal with the real world very well. And the real world has come in with the black swan event that it can't compute. What is the economics of this? What is the economics of complete standstill economy? Nobody knows. So yeah, and if they say they know, they're making it up.
And I think, as we talked about in the beginning, it shows how fragile everything is, and there's not much strength and resilience in the actual systems and the whole. The system is built on everything just moving forward and growing. And you know, I came across a documentary a few years ago called Happy, and it really delved into what makes us, you know, as a society on a human level, what are our needs, what gives us fulfillment. And once you actually earn over a certain amount, like once you've got everything provided for you, you know, the difference between 40k and 400k, there's not much more happiness between there as such.
No.
And I think that, I can't remember the actual state around the world, but they measured, they didn't have gross domestic product. It was based on gross domestic happiness. So the entire society was built on what makes us happy, not on what actually is going to make more money, what's going to increase it. And every time you put on the news, it say, oh, you know, the FTSE's this, the FTSE's that. And it doesn't really mean that much to a lot of people on a whole, other than for when they come to retire and if their pension pots are in there. So it seems like we could potentially go through a paradigm shift through all of this as well, to us on an individual level, realizing what makes us happy, what are our needs, and potentially shift us in a different direction. But maybe that's me being super optimistic, but we'll see.
Yeah, I think most people are going to go to the pub.
Yeah, they're going to go to the pub.
After that,
talk about these things at the pub.
Exactly. That'll be it. I agree. I think, I mean, to be sure, it is resetting people's values. And the thing about this, like you said, it's not going to be just a week. I think if it was just a week, people can live in the bubble and pretend it's not happening. But if it's 3 months or 6 months that this drags on for, then no, by the end of that, we will be changed. And let's hope that the narrative that comes out is not a selfish one, that it's one where we start to realize that we are interconnected and interdependent, and that if we want people to put their lives on the line and be the doctors and nurses that make us better, we have to pay them. And if we want hospitals to be available when we need them in a crisis, we have to build them. They don't, you know, I know we've not won up 4,000 beds in the Excel Centre, you know, that isn't really a solution in my view. And I think, you know, and I think the last bit is that when people's lives are turned upside down by external, exogenous type shocks, we shouldn't judge them. And we should help them. Because we were all that person at one point. This year, everybody, big or small, you know, either they lost 50% of their money on the stock market in the last 2 weeks, or they just lost their job with no notice. And their business just closed without any warning. And I think that is going to be the thing that makes people realize that they're more reliant on society than they thought they were. So, and that our civilization doesn't come from being the best version of myself. Civilization comes from the society that gives me the choice to do that. And maybe it will wake us up to that. I don't know. It's the classic one of the people who are very meritocratic, because meritocratic people tend to have gone to private school and had a lot of advantages, and their confirmation bias deletes all those as if they were the norm, because all their friends have the same advantages. So like, well, I did perfectly well. Look at me versus my friends. When I go to my school reunion, I've done better than them. And it's like, yeah, and then let's compare yourself to all the people who didn't have all your advantages. And now how do you feel? So I think it's this, maybe it will prick the bubble. Maybe it will make people realize that their world is not the world.
Yeah.
And that the idea of, and that someone in a different world isn't somehow, well, that's their, that's a function of their choices or their bad judgment or their morals or whatever. It's a function of, it's a lot of it is where you were born and how much money did you have when you were born. That's a proven thing in terms of health, by the way. If you want to get if you have your health insurance, 95% of your health outcomes that they are insuring against come from your postcode. Not even, and that's a postcode down to, I think, four digits of the 6 digits on the postcode. That will predict your health outcomes. No matter how much exercising you do, no matter how, all the stuff that you do to live longer and be healthier, it's your postcode.
Crazy.
Mad. 95% of it's your postcode. The 5% you can do something about.
So location is key then.
Absolutely. Yep. You want to be born in a really healthy postcode.
Yeah. One thing I'd love to get your insight on is in terms of like education and how we should be educating children on money as such. Like, I think back to school, I had maths, of course, which was, key, but actually about money, it doesn't seem like that was kind of built into it. And as soon as you leave university, anything, you're out in the real world, and it can be a shock. And I think if we were making people, giving them more skills and making them more resilient and empowering them more from that place, then it feels like we're going to have a better society in generations to come.
Yeah, and it's not educating them in finance. So at the moment, we educate teenagers essentially about credit cards and debt. But we don't educate them about how money works. There's actually a really good book that does a pretty good job. Dorling Kindersley have a book about money and how it works. I would recommend as a first thing for kids to look at. It's a little bit, I'd say, it's a sort of 12 to 16-year-old type book. But I think, no, we don't teach people about money. And I think one of the things that I've been thinking about and starting to ask whether we can get funding for is actually having, because actually you need to teach different things. So I think you need to teach people about money and how it works, because how do you understand what the chancellor is saying if you don't understand about money? If you're listening to the budget speech and you're just listening for whether or not you're going to have to pay more for a pack of cigarettes, that's because you're not understanding how money works. And so there's the first thing is like the public understanding of money and finance, and someone whose job it is to really ensure that, like a poet laureate, it's kind of the same kind of deal. The second bit would be that actually introducing finance and money into more curricula of other subjects. So sociology, geography, economics does not study money. So because the people who actually study money the most are mathematicians, and weirdly some physicists. So the people who are building these quant trading things that keep making the markets go weird, they're physicists and mathematicians. They're not economists. And so they don't really have an interest in money. They have an interest in numbers and statistics. And a lot of our decision making about money is being driven by people who are pretty divorced from the things we're doing money for. They're just looking at money as if it was a prime number that you were trying to find, or a theorem you're trying to prove, not an outcome you're trying to create. So if you want that, you got to build sociologists, give them the tools to think about money. You've got to get historians thinking about money. You've got to get novelists writing about money, English students. So for me, it's actually embedding it more into the curricula of these other subjects rather than money itself being a subject. For me, money being a subject is a bit like saying that language is only the preserve of linguistic students. Money is something that all subjects should have a view on, but they don't. And how you integrate that is a bit of a challenge.
Yeah, it's tricky, isn't it? We've got a school system which a lot of people would suggest is still based running off the Industrial Revolution kind of model. And I wonder whether there's a more holistic approach to educating kids and a different way of learning, like particularly saying about money, but also health and well-being, having that more integrated into it as well. Having people growing their own food, how, you know, look at it now, things are popping up now, how people, I'm sure off the back of this, people are going to think, well, I want to start my own garden and grow, you know, because how things are going to unfold. So,
well, absolutely, yeah. I think so. There's an element of self-reliance in that. I think it's also, I've got 5 children. I've sort of watched them go through the various incarnations of the sort of personal responsibility and citizenship kind of studies. And what's interesting is how little things like tax and social responsibility are really talked about. It's a lot of it is about personal development and mental health. Not very much is about, I don't know, voting or how local authorities work, or, you know, getting involved in things. It seems to be rather absent from the curriculum at the moment. Maybe that just reflects the politics that we're in. But I think the thing I'm not seeing from children is they don't come out of school with an understanding of the state, and an understanding of the debate between market and state, or they sort of, they're given some tools for thinking about being a public individual, but a lot of them are to do with being private individuals. And those are the bits where I think we've probably got the balance wrong. Why have people turned around to these rules and edicts about being locked down in the way that they have? Because we've educated them for the last 20 years that they are in charge of their own destiny and they make their own choices. And that's a good thing. So when we tell them they can't have those choices, they rebel and they don't understand. So yeah, I feel like we're having to reprogram people.
yeah, getting forced to be reprogrammed as well. So you've got 5 kids. What, you know, must be great for them to have someone with your, you know, wealth of information when it comes to finance and money. What, you know, can you ever think of what's the best advice you might have given them on money?
Yeah, don't do what I did. Don't do what I do. Do as I say. Yeah. I don't know. I think the thing I help them do is demystify some of the choices perhaps that they think they've got. Student loans is a good one. You know, teaching them that repaying that is not the thing you should do. It's not a debt. It's been called a debt, but it isn't really a debt. It's a tax. And if you think of it as a debt, you'll do the wrong thing. So I guess, yes, sometimes I will introduce, you know, those categories that we put around money aren't always the most useful. You know, the way we privilege savings over investing, for example. Savings are not really useful for the long term. They get eroded by inflation by definition. So, you know, if you're not taking risk, you're not getting return. If you're not getting return, inflation is eating it. And so things like that, yeah, maybe I've tried, but in the most part, I think their main challenges are the fact that they're coming into their adult world in deficit already. They're in debt, or at least they've got this deficit of tax, and then they're in deficit because their first job won't pay for everything they need. and we have an economy where your first job is not sufficient to live on, which seems wrong. And it's the case, and it's driven by two things. And what I try to explain is, don't feel bad about that. It's the system, not you. It's a system that has given this massive tax incentive to the value of property, such that now you can't afford rent, because rents are a function of the value of properties. And it's got to the point where that the ownership of property is extracting so much money from young people now that they can't afford to live. So the reason why you feel poor in your first job is not because you're doing badly. It's because the system is against you, and you either play that game or you don't. So I think that's probably where I'd sort of focus for people, is like, actually it feels a bit horrible. We were supposed to be not in a recession. This is winding back to the dim and distant 2 weeks ago. We've had 10, 12 years supposedly of unparalleled growth, and yet nobody's benefited from it. And you shouldn't feel bad because nobody has benefited from it. It's a bit of an illusion. And arguably the virus has sort of dragged down the curtain and showed that the Wizard of Oz is behind the curtain pulling levers, and they don't really do very much. They just make a lot of noise and thunder and produce very little in terms of value. So yeah, I think that's the main thing I'm sort of teaching them. I wouldn't presume to tell them how to run their lives. I can barely keep up with what social media channel they're on.
I bet, especially the 5 of them.
Yeah, and they're all different ages. They go from 11 up to 25. So they're all, I've got whatever that is. That's not millennial, is it? The one after millennials, and then all the way down to whatever this generation is going to get called.
Yeah. No, that's interesting. You mentioned a book before for Good for Teenagers. What books would you recommend, or resources for people who are more, out in the working world, that could help them to get more of an understanding on money?
There aren't many. There are some quite good histories of money that I think are quite useful to read. There's A Social Life of Money by Nigel Dodds, which will kind of jolt you a bit into thinking we've never been here before. It tells the really interesting story of when the Irish banks in the 1970s went on strike and everyone thought the end of the world would happen. And instead, people used pubs as banks, and it worked perfectly well. The economy functioned. It didn't actually drop a beat.
Wow.
So yeah, I think that's quite an interesting book. And actually, I'm trying to write a book about crowdfunding and money. Whether we'll get through to that, but I think actually there isn't really that many go-to kind of texts, I would say, unless you have a sort of research interest, in which case you start with, there's various sociologists that write very well about money, and anthropologists. So you've got Viviana Zalitzer, you've got Bill Maurer, you've got who else is there? They're the main ones, but I think those are quite theoretical books, and I think so. The sort of theory of money and so on has been very unfashionable in academia for a very long time, and is just now starting to come back. But then, in terms of books that talk about money, actually, it is relatively few. It isn't. I don't know. It must be a very hard book to pitch. And I think there's a book that could definitely be written about the myths of money, the things we say about money that actually aren't true. Like, there's money in the bank. There isn't any money in a bank. They don't hold money. The money that you have in a bank, the cash, is actually in the Bank of England. It's deposited with the Bank of England because banks aren't allowed to hold money. They don't work like that. Building societies do, but not banks. So building societies lend your money. Ecology, as a building society, they lend your money that you've lent to them. A bank doesn't. In a bank, you're something else. You're a creditor to a bank, and you're number 3 creditor behind bondholders and shareholders, which is why you get no return. So you're taking the lowest risk. You're not the first to lose the money. That's the shareholders, then it's the bondholders, then it's you. So when people moan about banks not paying interest, it's because you're not taking any risk. And so I think these are the sorts of things which I think we need a bit more discussion about, and understanding of, because the whole, when the crisis happened, I was in Kingston, and the first bank run in the UK for 100 and whatever it was years, 120 years, happened in Kingston in the Northern Rock. And it was all because a few people couldn't get in the branch and started queuing out the door. And then other people saw it. And they all then started queuing to find out what was going on. And then that went on the BBC News. And by the next day, we had a bank run. So no, without the internet, we didn't have Twitter. We didn't have anything. It was just, have you seen, there's a queue outside Northern Rock in Kingston. And the BBC turned up and filmed it. And that was it. That was the bank run.
So if the BBC didn't turn up, it would have been all right.
Well, it wouldn't have gone quite so quickly.
Yeah.
We wouldn't have gone to ATMs closing down in 24 hours if that hadn't gone quite so, in inverted commas, viral.
Yeah, absolutely. And it's the same a bit at the moment in terms of if people were panic. If all of a sudden, I was thinking about this the other day when we went to the supermarket, if all of a sudden people were running into the supermarket, then everyone else would be like, I need to run in as well. I need to get what I can. But actually it's quite calm, and I'm quite admire how, as a collective so far. Now, I don't know when this actually podcast goes out, what the world's going to look like. But it's quite it's quite reassuring at the moment. People are being pretty calm about it.
Right. Okay. I've not ventured to a supermarket yet. I've been biding my time. But the last time I went in one, it looked like it had been ransacked by the Vikings. So
yeah, the one I did go in to Sainsbury's recently, and it was it was pretty decimated, the shelves. But surprisingly, between it all, I could still get 95% of what I needed.
Yeah.
But anyway, that's
right.
By the by. But what?
That's the point.
It's been really good talking to you today and to getting all this information, because hopefully by this getting out there, it's going to educate more people about money and finance, but also that actually people can, where they can put their investments, and they can actually do it for you guys, and to see where it is, be investing in green technologies and see a decent return on it as well. So, there's hopefully this will open a few people's eyes to it. And I know the climate's a bit challenging at the moment, but, things will get better, and it's about planning for the future and looking further ahead. So, it's
exactly. There's no point getting to the end and having nothing. Yeah.
Yeah.
There's no point getting to the end. Sorry, Carol.
No, it's okay. Just one question I'd love to ask all my guests is, so this podcast is about sharing what good people are doing, and you've obviously been doing that for longer than 8 years or more. What advice would you give to someone who's looking to go out and do their own bit of good in the world?
I think there's a lot of myths about being an entrepreneur, which are about, making money and being successful in terms of building a business and selling it. I think if you want to be successful doing good, you find something that you want to, that no one else is doing and needs doing, but that you want to do yourself for a long time. So don't look at entrepreneurship as simply a function of get rich quick. Entrepreneurship can build very long-term things. And arguably, the biggest entrepreneurs, the Victorians, they built businesses that have lasted for hundreds of years, right? They're the real entrepreneurs. It isn't, and I think we put a language around it. So don't feel afraid of the idea of being an entrepreneur to do good, because it doesn't mean that you have to be Richard Branson. Actually, you don't have to be greedy. You don't have to make $1 billion. You can be an entrepreneur, and you can continue being an entrepreneur your whole life without ever making any, huge amounts of money, but you can do good. And I think that sometimes people who feel they're doing good kind of feel that they should push away that world. Don't be an entrepreneur. Don't be into capitalism. Capitalism is a tool. It's a way of getting things done. And you have a choice what you do. It is not a given that capitalism always produces unfair outcomes. We are the ones who produce the unfair outcomes. It's a political choice. We always say investing is a political act. Investing is about deciding what world you want to be in the future, and having a say in it because you've made an investment. And I think the same is the case in terms of your job or your vocation. It's about having a say in what the world looks like because you're doing it. But don't be afraid of using the means by which people have done some pretty bad stuff to do good stuff. It isn't the case that you have to work that way. You can employ good governance. You can be fair. Just don't be greedy. And I think that for me would be the one where, that's what helps you do good. That's what helps you stay on the course and not get distracted. There's a thing about finance in particular, which is there's always this easy road on the left. There's always the smooth path. And the other way is a complete minefield. You have to go through the minefield every single time. The easy path is always there, though. It's very easy to go down it. But if you do, you lose your way.
That's really great advice. If anyone is listening to this and wants to find out more about you guys, what's the best way that they can, make an investment or just at least delve into you guys a bit more?
Well, I think our website is abundanceinvestment.com. And we have lots of stuff there about the impact of our investments, and you can kind of dive in and read the blogs and read about who we are and why we're doing stuff, and read about the investments we've already done. And when you've done that might inspire you to make an investment yourself.
That sounds great. I'll be sure to include the links as well to what we've spoken about today, and the links to, your company and the books that you've spoken about. I'll definitely be looking into some of them books myself as well. But Bruce, it's been a pleasure speaking to you today, and I really appreciate your time.
That's fine. And thank you. Thank you for getting in touch and setting it up.